Most people have left thousands on the table, literally missing out on guaranteed money, all because they ignored high-yield savings accounts and CDs for too long. If you're earning under 5% right now on your cash, you're losing money to inflation, plain and simple. Even with Fed Chair Jerome Powell's recent comments suggesting a potential shift in 2026, the smart money is still locking in these rates. Think about it. In 2022, many kept their cash in traditional bank accounts earning next to nothing while rates climbed. Then in 2023 and 2024, they chased volatile stocks. But what if you could have earned 4%, 5%, even 5.5% on money you weren't even actively investing? We're going to crunch the numbers on HYSAs and CDs today, show you the real returns after taxes and inflation, and why ignoring them in 2026 could be one of your biggest financial mistakes. The lesson here is simple. Your idle cash should never truly be idle. Alright, let's talk about the money sitting in your bank account, and more importantly, the money it could be making. You know, for years, the idea of getting any real return from a savings account felt like a joke. The national average was stuck around 0.1% for what felt like an eternity. But then came the 2022 rate hike cycle, driven by Jerome Powell and the Federal Reserve, and suddenly, the landscape changed dramatically. Fast forward to January 2026, and while the national average for traditional savings accounts is still a paltry 0.4% according to some reports, leading high-yield savings accounts, or HYSAs, are offering rates several times higher. We're talking about banks like Capital One, American Express, and Ally, all FDIC insured, all fully liquid, and all paying out significantly more. The difference? For someone with $25,000 saved, that could mean going from earning just $100 a year to potentially over $1,250 a year, just by moving their cash. That's real money, not just theoretical pennies. But here's where it gets interesting, and where most people are still missing a massive opportunity. Understanding the trade-offs between that HYSAs and something like a certificate of deposit, or CD. Especially when inflation, even if it's cooled from its 2022 peaks, is still a factor that eats into your real return. We're going to dive deep into what those real returns look like in 2026, comparing the flexibility of HYSAs against the locked-in rates of CDs, and what that actually means for someone in your situation looking to optimize their cash. The lesson here is that leaving your emergency fund in a traditional savings account is practically guaranteed to cost you thousands over the next few years. So, let's crunch some numbers. Okay, so what does 2026 actually look like for your money? Well, as of January 2026, the national average savings account APY is a frankly dismal 0.4%, according to a recent analysis by Bloomberg and corroborated by data from the Federal Deposit Insurance Corporation, FDIC. That's barely moving the needle on your money, even if you have a significant chunk saved, say, north of $50,000. To put that in perspective, consider the broader U.S. personal savings rate. It actually dropped from 4.1% to a concerning 3.5% between August and November 2025, per the Bureau of Economic Analysis, BA, preliminary data. This isn't just a number, it highlights a real shift where American households, from young professionals like Sarah Chen in Brooklyn to retirees like the Millers in Arizona, need smarter, more active savings strategies to combat inflationary pressures and stagnant yields. The Federal Reserve's decisions are key here. As of their Federal Open Market Committee meeting on June 17, 2026, the Fed maintained the federal funds rate at 3.50% to 3.75%. This benchmark rate directly influences the annual percentage yield, or APY, offered on savings accounts and money market funds. Even with that federal funds rate, many traditional banks, including giants like Bank of America and Wells Fargo, are simply not passing those benefits onto their average retail customers, often citing operational costs and market stability. This economic environment, extensively discussed in financial articles as recently as March 19, 2026, by analysts like Dr. Evelyn Reed at Goldman Sachs, means understanding your real returns after inflation is more critical than ever. Think about it. If you had $10,000 in a traditional savings account earning 0.4%, you'd earn just $40 in a year. Meanwhile, even modest inflation, hovering around 2.8% as of early 2026, eats away at that. your money is effectively losing purchasing power over time. The lesson here is that relying solely on traditional bank accounts means you're almost guaranteed to fall behind. To stay ahead, or at least keep pace with the cost of living, we need to look beyond the basics. To put that in perspective, a high-yield savings account, or HYSA, as defined on February 4, 2025, typically pays significantly more than the national average. We're talking rates several times higher than that 0.4% we just discussed. For example, banks like Capital One, American Express, and Ally are consistently offering rates in the 4.5% to 5.0% range right now. If you had that same $50,000 in an Ally HYSA earning 4.75%, you'd be looking at an extra $2,375 in interest over a year, compared to just $200 from a traditional savings account. That's a difference of over $2,100, just for moving your money to a better account. The beauty of HYSAs is their flexibility. Unlike a certificate of deposit, which we'll get to next, there are no lock-in periods. You have easy access to your funds at any time, without penalty. Let's say you need to tap into some of that cash for an unexpected expense, like a car repair. With a HYSA, you can transfer it out just as easily as you put it in. Crucially, these accounts are also FDIC insured, providing the exact same security as your traditional checking or savings account. That means your deposits are protected up to $250,000 per depositor. So, while you're earning substantially more, you're not sacrificing safety. The lesson here is that HYSAs offer a powerful combination of higher returns, liquidity, and security. Now, that flexibility is a major advantage, especially in an uncertain economic climate where you might need quick access to your emergency fund. But what if you know you won't need that money for a while? What if you're looking to maximize your return by locking in a rate? That's where certificates of deposit, or CDs, come into play in 2026. Okay, so while HYSAs offer that sweet spot of high returns and liquidity, certificates of deposit, or CDs, bring a different flavor to the table. Think of a CD like a time capsule for your money. You lock it away for a specified term, anywhere from a few months to several years, and in return, the bank guarantees you a fixed interest rate for that entire period. This fixed rate can be a huge advantage. For example, if we enter a falling interest rate environment, like what analysts at Forbes were discussing in their May 2026 outlook, locking in a 4.8% rate on a one-year CD, like the top picks Glenn Luke Flanagan highlighted for Personal Finance Commerce, means you're still earning that 4.8% even if the Fed cuts rates and HYSA yields drop to, say, 3.5%. However, that lock-in works both ways. Let's say you put $20,000 into a 3-year CD today at 4.75%. But 6 months from now, the economy booms and interest rates for new CDs jump to 5.5%. Your money is still earning 4.75%. And accessing that money early usually comes with a penalty, often forfeiture of several months' worth of interest, which can eat into your principal, as Raisin pointed out in their comparison of HYSAs versus CDs. The good news is, like HYSAs and traditional savings accounts, CDs are also FDIC insured, so your principal is protected up to $250,000 per depositor, per institution. The lesson here is that the decision between a HYSA and a CD in 2026 really boils down to your need for flexibility versus your desire to secure a potentially higher, guaranteed rate for a set period. Now, let's dig into how the Federal Reserve's actions impact these rates. That fixed rate can be a huge advantage. Now, when we talk about maximizing those returns, we have to talk about the Federal Reserve. Their actions directly impact the APY offered by banks. For example, the Federal Open Market Committee's decision on June 17, 2026, to maintain the federal funds rate at 3.50% to 3.75% provides a baseline for what banks can offer. When the Fed raises rates, HYSA APYs generally follow, often with a slight lag. But the flip side is also true. If the Fed decides to cut rates, those HYSA APYs can drop just as quickly. This is why, for HYSAs, consistent players like Capital One, American Express, and Ally remain top options in 2026. They've been offering rates significantly above that 0.4% national average for a while now. But for CDs, that lock-in advantage can become a disadvantage if rates suddenly surge. Imagine locking into a 3% CD for 3 years, and then 6 months later, the Fed hikes rates, pushing new CD offerings to 5%. To mitigate this, many investors consider staggering their maturities, a strategy often called CD laddering, which was discussed in detail in financial articles published on March 19, 2026. This means you'd have CDs maturing at different times, allowing you to reinvest at potentially higher rates if the market shifts. The lesson here is to always compare APYs across multiple institutions. Don't just look at the headline rate, dig into any potential fees or minimum balance requirements that could eat into your returns. Understanding the Fed's stance and diversifying your maturities can help you navigate the current rate environment. But even with these strategies, we have to consider the silent killer of savings: inflation. The real returns you're getting. When the Fed raises rates, HYSA APYs generally follow suit. But here's the crucial part. The true measure of your savings growth isn't just that stated APY. It's what we call the real return, your interest rate minus the rate of inflation. And this is where many traditional savings accounts fall short. Think about it. As of January 2026, the national average savings rate was still a dismal 0.4%. Now, let's compare that to the US headline inflation rate, which, as of June 26, 2026, hit 3.6%, partly due to rising energy costs. If your money is sitting in an account earning 0.4% while inflation is at 3.6%, you're actually losing purchasing power. That's a negative real return of 3.2%, your money is literally eroding in value. This disconnect is exactly what an article authored by Glenn-Luke Flanagan and Cassie Bodorf highlighted, emphasizing how critical Federal Reserve actions are in determining those APYs, which then directly affect your real returns. They make it clear that to combat this inflation erosion, we must seek out accounts that offer rates several times higher than that national average. This is where HYSAs really shine. For someone looking to park, say, $50,000, simply letting it sit in a traditional account means you're almost guaranteed to lose ground against inflation. You need an account earning that 4.5% to 5.0% we discussed earlier to give your money a fighting chance. Understanding articles like The Truth About High-Yield Savings Accounts and CDs in 2026, Real Returns, is about ensuring your hard-earned money isn't just sitting there, but genuinely growing, keeping pace with, or ideally, beating, the rising cost of living. The lesson here is that a high nominal return isn't always a high real return. Instead of letting inflation slowly chip away at your hard-earned money in a traditional savings account, 2026 is truly a year where actively choosing a high-yield option can make a tangible difference. We saw how a 0.45% average national savings rate, compared to a 3.5% inflation rate, means losing purchasing power. But with HYSAs currently in the 4.5% to 5.0% range, and CDs offering similar fixed rates, you can not only outpace inflation but also see real growth in your savings. The lesson here is that simply letting money sit isn't enough, it needs to work for you, especially with Jerome Powell and the Fed's careful dance with interest rates. Have you ever switched from a traditional savings account to a high-yield option and seen a significant difference in your annual interest? Or maybe locked into a CD rate only for the Fed to raise rates later? Drop your experiences and how it impacted your savings below. And if you want to keep making smart money moves, make sure you hit that subscribe button. We break down complex financial topics into actionable insights every week. If you found this helpful, my deep dive into how to calculate your true after-tax investment returns is exactly the next thing you should watch.